Introduction to bonds. Debt capital consists of mainly bonds and debentures. The holder of debt capital does not receive a share of ownership of the company when they provide funds to the firm, but he becomes a creditor to the firm. In return for loaning this money, bondholders have a right to certain guaranteed payments during the life of the bond. For an illustration, a company issued a bond of a face value of rupees 100 carrying a coupon rate of 10% for 10 years. This entitles the bondholders to receive rupees 10 for 10 years as interest. At the end of 10th year, the bondholder is also entitled to receive back the invested amount of 100 rupees, irrespective of level of profits or losses which the company makes during that period of 10 years. The bondholder is entitled to receive the coupon interest during that period. If the company fails to pay coupon interest or redemption value at the end of the term, the bondholder can take legal recourse against the company. Thus, from the viewpoint of the provider of the debt capital is less risky in comparison to the equity capital. It has a further advantage over equity capital from the point of view of the firm. This advantage relates to different the differential tax treatment of interest payments on debt and dividend payment on equity. The interest payments on debt are said to be tax deductible, which means that the interest payments are deducted from total income to arrive at the taxable income of the company. In contrast, the dividend payments are non-tax deductible, thus two companies with identical operating incomes but which differs in terms of their level of debt will have different taxable income and therefore different after tax income computation. This tax deductibility of debt payments means that the debt capital provides a tax shield which is not provided by the equity capital, thus further lowers the cost of debt from the point of view of the firm. Bonds are negotiable promissory notes that can be used by individuals, business firms, governments, or government agencies. Bonds issued can be secured or unsecured bonds. In case of bond, the rate of interest is fixed and is known to the investor. A bond is redeemable after a specific period. The expected cash flows consist of interest payment plus repayment of principal. Interest is usually payable at fixed interval, semi-annual, sometimes monthly. The holder of the bond is the lender or creditor. and the issuer of the bond is the borrower or debtor. Bonds provide the borrower with external funds to finance long-term investments. Certificates of deposits or short-term commercial paper are considered to be money market instruments and not bonds. The main difference is in the length of the term of the instrument, as the ownership of the bond can be transferred. It is highly liquid in secondary market. A bond might be sold at above or below par or the amount paid out at maturity, but the market price will approach par value as bond approach maturity. Terms associated with bonds. Next.